Maximizing Price Stability in a Monetary Economy by Warren Mosler and Damiano, Silipo. Section 5. Evidence on the Impact of the ECB Monetary Policy. In this section, we provide empirical evidence with regard to the ECB monetary policy in the euro area. The aim of this exercise is only to give an idea of the history of monetary policy, inflation, and growth in the euro area, and based on the ECB's own functions and assumptions of the likely impact the ongoing ECB quantitative easing program can have on growth and inflation in the next 2 years. The success of conventional and unconventional monetary policies in achieving price stability, given the assumptions that price stability is a function of rates and expectations, further relies on the working of two transmission mechanisms. 1. The ability to affect relative prices of long-term securities relative to short-term securities. And 2. The ability to bring inflation expectations toward the targeted level. See Figure 1. To estimate to what extent these mechanisms may be presumed effective, we tested a vector autoregression VAR model with quarterly data from 1999 first quarter to 2015 fourth quarter for the euro area. We also performed a forecasting exercise, assuming the ECB will increase total assets by 60 billion euros per month until the end of 2017. The VAR model we consider is y sub t equals alpha plus a as a function of L times y sub t minus 1 plus b epsilon sub t, where y sub t is a vector of endogenous variables, alpha a vector of constants, a as a function of L is a matrix polynomial and the lag operator L, and b is the contemporaneous impact matrix of the mutually uncorrelated disturbances epsilon. In our specification, the vector of endogenous variables y sub t comprises three variables: the log of seasonally adjusted real GDP, the log of seasonally adjusted consumer price index, and the log level of the seasonally adjusted central bank assets. Footnote 1. It is commonplace that the central bank balance sheet is a more suitable tool for analyzing the macroeconomic impact of central banks' policies when the official interest rate reaches the lower bound. See, among others, Curdia and Woodford, 2003, and Borio and Distiatat, 2010. However, even when the policy rate is presumed effective, changes in the policy rate affect the size of the central bank balance sheet. On the other hand, the size and composition of the central bank balance sheet may also change endogenously because of the demand for reserves of the banks, as happened during the 2007 to 2009 financial crash. End footnote. By assuming the implementation of monetary policy actions is reflected in the size of the central bank balance sheet, our aim is then assess the overall impact of central bank balance sheet policies on inflation and growth, taking account of the agent's inflation expectations. Data for estimating the above VAR model come from the Eurostat dataset and the ECB statistical data warehouse. First, we performed the usual lag length selection criteria to estimate lags of the endogenous variables. It turned out that the 3 lag length was significant, although the results proved robust to different specifications of the lag length. Therefore, we estimated a 3 lags VAR system using ordinary least squares, OLS. Levels and changes of the variables are quarterly. In Figure 9, we report the accumulated impulse responses for the full period. It is remarkable to notice that the accumulated response of inflation, GPCONS, and real GDP growth, YR, to exogenous shocks in the ECB balance sheet, BCE is negative and becomes positive after 6 quarters. These results support previous conclusions regarding the weak impact of the ECB monetary policy on inflation and output. To understand to what extent these results are influenced by the crisis period, we estimated separately the accumulated impulse response for the periods 1999 to 2006 and 2008 to 2014. The results are reported in figures 9b and 9c. Indeed, the results in Table 9a are driven by the period subsequent to 2007, see Figure 9c. By contrast, in the period preceding the financial crisis, a random shock in the ECB balance sheet determined a positive impact on both inflation and growth, Figure 9b. These results suggest that the monetary policy has been ineffective in spurring inflation and growth in the crisis period. Indeed, in this period, the ECB mainly played the passive role of providing the liquidity necessary to save distressed banks, rather than an active role in promoting price stability. By contrast, after 2013, the primary target of the ECB has been the fight against deflation in the euro area. Therefore, utilizing the ECB's internal methodology, what is the likely impact on inflation and output of the ongoing program of asset purchases by the ECB, taking account also of the latest inflation expectations surveyed by the ECB for the euro area. Table 2 reports the results of the forecast simulations assuming that current European monetary policy is carried out until the end of 2017. That is, ECB balance sheet increases of 180 billion euros per quarter. Footnote 2. Indeed, the ECB security purchase program started in March 2015 and is expected to end by September 2016. End footnote. In the 2 years ahead, inflation expectations, INFLE2 is equal to 1.5%, the same as the latest ECB survey of December 2015. Footnote 3. Notice that, among others, we are abstracting from changes in the rest of the world that can affect inflation expectations and the other variables used in the VAR model. End footnote. The results of the forecast shown that, given the ECB's own assumptions and the empirical evidence, even if the ECB pursues the current policy of an asset purchase program until the end of 2017, the target inflation rate of 2% is unlikely to be achieved. Footnote 4. Gambacorta et al., 2014, estimated that the impact of an exogenous increase in central bank balance sheets at the zero lower bound in most advanced economies leads to a temporary rise in economic activity and consumer prices, but the impact on the price level is weaker and less persistent. End footnote. More worrisome is the low growth rate of the real GDP forecast, shown in the last column of Table 2, suggesting that current monetary policy is unlikely to bring the euro area out of the present sluggish growth rate. From the previous analysis, it is straightforward to conclude that, given the data and the ECB's assumptions, current monetary policy by the ECB is unlikely to lead to price stability in the euro area. This is because, in the context of large output gap, presumed inflation expectations, which are further presumed to cause inflation, hamper the achievement of the monetary policy target. In the next sections, we provide evidence that a labor buffer stock policy is a superior policy in achieving price stability relative to current policy, with respect to both the costs and benefits of monetary policy.